Welcome again to the Prosperity Thrive Drive, where we thrive boldly and prosper fully. This is Charity Mwangi, your host right here. And before I proceed, allow me to appreciate each and every one of you that have watched our previous 2 episodes, that have subscribed, that commented, that encouraged me, that inspired me. Thank you so much for your comments. Thank you so much for your likes. Thank you so much for your subscribing. And for those who forgot to subscribe, please click on that subscribe button at this moment and support our channel. And let's grow together. Let's thrive together. Let's encourage each other. Let's inspire each other. And let's move forward together. So today is another new episode where we are also going to talk about debts. But in this episode, we'll talk about the types of loans that we have that are offered in the market and how all these loans are different from each other, because every loan serves a different purpose based on how each lender designed it to be. So let's get started. So before we move to the different types of loans, based on a survey conducted by Geopol last year, 2024, it indicated that over 80% of people have incurred debts. They're in the process of debt repayments. Some of them are even in debt cycles, where they keep on taking a loan after another, and they're in that cycle where they feel even they are not able to get out of it. So that's the reason why we'll keep on talking about debts, keep on talking about debt management until we are all able to manage our debts and even live a debt-free life. Have you ever taken a loan and wondered, how did this end up being so expensive? How did this interest end up being so high? I didn't anticipate to repay such an amount of interest. I'm still in this cycle that is never ending, and it looks like the loan seems to be never ending. Stick around. So in this episode of the Prosperity Thrive Drive, we'll dig into some of the things that people need to understand and need to know, the different types of loans, the different lenders, the different interest calculations that are available in the market, and everything that we need to know about the loans. So let's get started. Number 1 is what I would call the term loans. And these are loans given by banks, by SACCOs, by MFIs. And characteristics of this kind of loans is that you're given a fixed amount of loan, and then the loan repayment period can range between 6 months, even up to 30 years. So most of these loans are long-term loans, like the mortgages, like the development loans, the construction loans, and all that. So with this type of loans, the interest is calculated on amortization, and some are calculated on reducing balance. And in another episode, we'll talk about the different types of interest calculations for loans. So in this case, these loans are very structured, because you're given a repayment period where you're given the amount of installments that you're supposed to repay for this type of loan. And based on the calculations, you'll find that you're either given a fixed amount that you're supposed to pay on every month, or maybe if it's a reducing balance type of loan, then the amount will keep on changing. But you're able to see the principal amount and the interest amount and the total amount that you're supposed to be repaying every month. So these are the types of loans that you use to acquire assets that will bring income for education. These are types of loans that you get for business growth and business expansion, because they are long term. Because also for these cases, when you're buying an asset, probably it will not bring back the income immediately, but after some time, that asset will bring the income. So that's why you need that prolonged repayment period. The same thing with education. If you're taking a loan to go back to school or to sponsor someone who is going back to school, the return or the income for this loan may not be immediate, but probably it will be after the school course is done. That's when maybe you'll be able to get a promotion or get a new job based on that qualification. And so that loan becomes an asset because your income will increase. Also for businesses where maybe you need this loan to expand your business, to open new branches for your business, to increase stock. So with this, you are sure that once you do that, once you increase stock, you expand your business, you'll be able to get income out of that expansion. The next types of loans are the mobile loans, and these are offered even by banks. They are offered by some of the telecommunication companies that we have, and they're also offered by other lenders. The features for these loans is that they're easy to access. They're short term. Most of the time you're given probably up to 6, on the highest 6 months. It will start from 1 week. You can be given a loan where you're required to repay it within a week. The other feature is that they have very high interest rates because of the easy accessibility. It also means they are high risk, and therefore these types of loans have high interest rates. The calculations of these interest rates, sometimes you'll find them to be fixed interest rates or compounding. It depends on the different lenders and the terms and conditions of that loan. The caution about these loans that I would give, the ease of accessibility can cause someone to get into a debt trap and a debt cycle, because you can just think of something that you need and realize that you can be able to access that money from your mobile. So it's very easy to get into a debt trap or a debt cycle where you keep on getting a loan after another, repaying one, getting another. So it's not the best type of loan for everyday expenses, for everyday upkeep. These are loans that you only take when you have a real emergency. And once you take this loan, the moment you're able to access funds, repay them immediately, because the longer you stay with this loan without repayments, the more the interest that you will incur. The other type of loan that we'll talk about is the revolving credit. These are the credit cards and the overdrafts. For this type of credit or loans, they are given mainly by banks, MFIs, and even some SACCOs provide these types of loans. For this type is where you're given a limit where you can borrow from, maybe 100,000, and also these limits are determined based on your credit history with that lending institution. Some will be given 50,000, others 100,000, others 1 million. So, and these loans, they're suitable for business people. For those businesses that need, for example, to add more stock to their businesses, and maybe their cash flows are not good enough to top up the stock, they can utilize this type of loan to top up the stock and be able to repay it within the limit that they've been given by the lender after they receive the funds or the cash or the payments from their debtors. A caution about these types of loans, the credit cards and the overdraft, is that someone might not have the discipline to live within their means. When you already know you have an extra 100,000 that you can utilize, you can lose the discipline to live within your means because you're feeling like there is an extra amount of cash that is there for you to utilize. Yet you do not know that this money is not yours. This is money that you'll be loaned and you'll be repaying it with an interest. So if used wisely, especially for businesses, they can be able to cover the cash flow gaps that businesses experience. The other types of loans are the Shylock Loans. These are given by informal lenders or unregulated lenders. So for these kind of loans, the accessibility can be easy. However, their interest also is quite high. Some of these loans, the interest is calculated even on a daily basis. And if you don't pay on that day, then the interest is compounded, and the following day you'll pay interest upon interest of the loan. Okay, so they can end up being so expensive. And these loans, you'll find that the lenders will require you to give security for the loans that they've given you. And they'll take from household goods, from business goods, from logbooks and all that. And if you default on these loans, the lenders are quite harsh. You can easily lose your assets, you can easily lose your stock in the business, you can easily lose your household goods and your household items. So as I've said, the interest can be quite high, even up to 30%, even on a weekly basis. When you calculate that and convert that to monthly and even yearly, that interest is very high. The other types of loans is what I call the trade loans. and these mainly are for businesses. For example, if you're a business that deals with goods, sometimes you can get goods from your supplier and not pay immediately. So you're given credit to repay maybe after 30 days or 45 days, or repay whenever you're able to sell those goods. Based on the agreement that you have with your supplier, they may have a structure of the period that you're supposed to repay, if there is any interest that you're supposed to incur. All these terms and conditions should be very clear when you're acquiring this type of debts. The good thing about these loans, they help the business to continue supplying their goods and continue serving their customers even when the cash flow is quite low. The other types of loans is what I call stakeholders loans. And business will have different types of stakeholders. You'll have the employees, you'll have your landlord, you'll have the government, and you'll have the county government and all that. So for the salaries, at the end of every month, as a business person or a business owner, you know that you're supposed to pay your employees' salaries. So that's a kind of a debt that you need to pay and plan for. You know that you're supposed to pay your landlord the rent for the following month. So that's also a debt that you're supposed to account for. At the end of the month, for the businesses that pay taxes on a monthly basis, for example, those who are registered for VAT, you know at the end of the month that you're supposed to take into consideration the taxes that you're supposed to be paying to the government. And if it's at the end of the year, you're supposed to calculate the taxes that have accrued in your business for the whole year that you're supposed to remit to the government. At the end of the year, you know that as you start a new year, you're supposed to pay for your business permit. So all these, they may not be structured loans or debts, but they are there especially for the businesses because they are payments that need to be taken into consideration when planning for the business finances. The final type of loan that I'll discuss in this episode is what I call the social loans or social debts. And these are the debts that you borrow from your family, from your friends, maybe to start a business, to go back to school, to do 1, 2, 3. And these are also loans that as an individual, you're supposed to account for and you're supposed to plan for on how you're going to repay. These types of loans might not have an interest. They might not have a definite period on which you're supposed to repay. But some of them, of course, will have a definite period. Some people will tell you, or you'll agree that you're supposed to repay this loan within 3 months, within 6 months, and so on. So these are also loans that you're supposed to plan for as you plan for your finances and your cash flows. So also remember, these are the loans that you're given based on trust, and it's very good to keep that trust. It's very good to protect the relationships that help you grow, that help you start the business, that help you go back to school. So it's very important to take that into consideration and plan on how you're going to repay these loans. So I'll attach an Excel sheet on the description box on the different loans, types of loans that we've discussed, the best cases when you're supposed to get these loans, their risk factors, the cost of these loans, the repayment periods, how interest is calculated for each of the loans that we've discussed. So I'll have that on the description box for your reference. So before you take any type of loan, as we've discussed, always ask yourself, do I really need this loan? Am I able to repay this kind of loan? What will happen if I default this kind of loan? Because based on the lender, the consequences are different. How the regulated lenders will deal with you is different from how the unregulated lenders will deal with you. So it's very important to note that and to take that into consideration. So will this loan give me peace, or will I always be anxious, waiting for that call from this lender? So ensure you take all that into consideration before taking any loan. Also, consider the terms and conditions of each and every loan. So people are borrowing every day. People are getting debt every day. the key thing to know and to understand is this loan empowering me, or is this loan enslaving me? So you need to know your loan, you need to know your limits, you need to know the terms and conditions of every loan that you take. So if this episode has helped you, please share it with someone else. Let's borrow wisely, let's live lighter and prosper purposefully. So thank you for joining me on this episode, on this third episode. Please subscribe, please like and comment and share with someone that needs to hear about this. And I'll be glad to join you in the next one. Stay tuned. Bye.